We are doing great. Now that we've analyzed Tesla's growth and profitability, let's go ahead and take a look at a few ratios that will tell us more about the company's liquidity. To be precise, I would like to go through Tesla's quick ratio, current ratio, days sales outstanding, days inventory outstanding, and days payable outstanding. The quick ratio gives us a brutal assessment of how liquid the company is at this very moment. This is a scenario in which we hypothesize that the firm will be unable to sell any of its assets and doesn't receive payments from clients, but still needs to cover its short-term obligations. To calculate the quick ratio, we have to take the sum of cash and marketable securities and divide it by current liabilities. Okay, now that I have created the formula, I'll simply paste to the right. Tesla's quick ratio in 2014 was close to 0.9, but then deteriorated significantly and became 0.26 during the first half of 2018. This is an important warning sign. For some reason, the company's liquidity deteriorated in the period between 2014 and 2018. Okay, let's go ahead and examine what happened. Next on our list, current ratio, which is very similar to the quick ratio, but is a bit more comprehensive. It includes all current assets. The current ratio is the fraction between current assets and current liabilities. It shows us what portion of a company's short-term liabilities can be covered by funds the firm expects to receive in the short term. Problems at this level are very alarming. A current ratio below 1 is quite problematic in most industries. Tesla's current ratio gradually dropped to 0.73 in the second half of 2018. So, I think we can agree that the company's liquidity needs to be examined further. One way to do that is to compare these ratios with those of other companies from the industry and see if this is a pattern that is commonly observed. If this isn't the case, then one cause of concern when we discuss Tesla should be its liquidity. Many people expect that the company will have to raise capital in late 2018 or early 2019, precisely due to the deterioration of liquidity ratios we see here. Great. Let's calculate days sales outstanding and days inventory outstanding, also known as DSO and DIO. To do that, I'll divide Tesla's accounts receivable by revenue in 2014. And we'll then multiply by 360, the number of days we have in a year, minus official holidays. This gives us the DSO figure for 2014. Let's copy and paste to the right. However, we have to be careful. The DSO figure for the first half of 2018 should be divided by 180, and not by 360. We are taking into consideration half of the year only. Okay, I can simply use the DSO formula and paste it for DIO, but this time we'll have to divide by COGS and not by revenues. Also, let's add a minus sign to obtain a positive result, given that we are calculating days. When we calculate DIO, we don't divide by revenues. We use COGS instead. This makes sense because DSO gives us information about the average number of days we wait for clients to pay for sales. Given that DIO is about inventory, it'll make more sense to divide by COGS, the cost at which goods are kept in our warehouse. Okay, great. Let's fix the row cell reference of COGS in the DIO formula and copy it downwards to calculate DPO. Also, we'll need to replace the cell reference of inventory with the one of accounts payable. I'll copy and paste to the right, and these are our DPO figures for Tesla. The last piece of the puzzle will be to calculate net trading cycle. This is equal to DSO plus DIO minus DPO. A company's net trading cycle tells us whether it uses its own funds when selling products to clients. If we owe more money to suppliers compared to the amount of money we are owed and the amount of money we have invested in inventory, then we are financing our activities by using other people's money. If the opposite is true, we need to use our cash to finance the business and keep operations up and running. Net trading cycle terms are highly dependent on a company's bargaining power and negotiating position when dealing with clients and suppliers. We can easily see that Tesla decreased its net trading cycle sharply in 2017. This probably helped the company address liquidity problems temporarily. However, my guess is that later on, in 2018, the company had to revert back to the normal level of working capital observed in 2014, 2015, and 2016. And this was the reason for significantly inferior liquidity ratios in the first half of 2018. So, Tesla will probably have to raise capital at some point to address its liquidity issues and be able to sustain its fast growth that we discussed in our previous lesson. This is a very subtle moment and is natural for a company that is still in its growth phase. The problem is that Tesla is already a listed firm with a very significant market cap, and raising additional capital will probably be seen as a sign of weakness by financial markets. Okay, I think this will do for now. Next on our agenda, solvency. Thanks for watching.